Good morning and welcome back to class. In this section, you will learn the final account of a sole trader. We will not dwell much on theories as tutorial material was made available in the first comment section. Get ready with your writing materials. Let's begin. Who is a sole trader? A sole trader is a person who owns a business and manages this business by himself. Like other forms of businesses, sole trader prepare accounts to assess the viability of the business. Now, the final account comprises three components, or rather two components. The first one is the income statement. The second one is the statement of financial position. The income statement is split into two segments: the trading account and the profits and loss account. In this tutorial, we are going to take a practical exam. I want you to learn by doing. So go ahead to take a practical example. Now, the source document for the preparation of the final account is the trial balance. All the information that you need for the preparation of the final account is taken from the trial balance. Now, the trial balance will contain almost all the information you need to prepare your final account. The first step you will take to prepare the final account is to classify all the information in the trial balance into assets, expenses, revenue items, and liabilities. After this classification, the expenses and the revenue item will fit into the trade. Why the assets and liability will go into the statement of financial position, otherwise known as what the balance sheet. Now we are going to take a look at example, and the question reads. The following data was extracted from the book of Fensway Limited as at 31st December 2025. The first one there is capital. Capital is 150,000. Drawing is 10,000. Purchases is 120,000. Return inward is 5,000. Return outward is 3,000. Opening stock is 33,000. Carriage is 4,000. Rent 12,000. A salary is 18,000. Electricity is 6,000, while furniture is 40,000. Motor van 80,000. debtors is 25,000. Our creditors is 20,000. Cash at bank is 15,000. And cash at hand is 5,000. Other available information are as follows. We have opening stock, we have closing stock, and the closing stock is 40,000 naira. The closing stock 40,000 naira, and the prepaid rent is 2,000 naira. We have depreciation on furniture is to be depreciated by 10%. Then we have salary outstanding. Salary outstanding is 3,000. You are required to prepare income statement, then 2 statement of financial position of Firmsway Limited as at 31st December 2025. That is the question. Now we are going to prepare. The first thing we are going to do is to prepare the trading account. The trading account, which is a component of the income statement, is in the same segment with the profit and loss account. Though they are split into two for purpose of learning, but they are not divided into two. It is two accounts fused into one. So the first thing we will do here is to find out the purpose of calculating, or the purpose of the trading account. And the purpose of the trading account is to be able to compute the gross profit. What is the formula for computing the gross profit? The formula for computing the gross profit is net sales minus return inward. Net sales minus return inward. That means to get your gross profit, you need sales and you need return inward, or sales return. And the gross profit is net sales minus cost of sales. That also means that you need to know the formula, or what constitutes cost of sales. There is a formula for cost of sales also. And the formula for cost of sales is is opening stock plus purchase plus carriage inward less return outward plus other direct expenses. These are plus other direct expenses, then less closing stock. Let me take it once again. The formula for calculating the cost of goods sold is the opening stock plus purchase less return outward. Then you add the direct expenses, then less closing stock. The direct expenses may be expenses like carriage, wages. These are expenses that are directly related to bringing the stock to a sellable condition. This one must be removed. That is to say, to compute the gross profit, you need the sales, return inward, opening stock, purchases return, carriage inward, wages if it is directly related to stock, After doing this, you less closing stock. So by knowing the formula of calculating the gross profit, that is net sale minus cost of goods sold, these are the ingredients that will go into the trading account. So in this question, the following ingredients will go into the trading account. The first one there that will go into the trading account is one, the sales. The next one there is the net, return inward, that is sales return. The next one there is opening stock. After opening stock, we look for purchases, less carriage, less return outward, plus direct expenses. That is to say that the purpose of computing the trading account is to get the gross profit, and the gross profit formula is net sales minus cost of goods sold, and cost of goods sold is opening stock plus purchase less return outward plus direct expenses, then less closing stock. Now, let us try to find out those information in this question that will go into the trading accounts. The first information there is what? Sales. And sales figure there is 200,000. So the first information there will be what? Sales. And we are going to pick sales. And the next information we need is sales return. We're also going to pick sales return to find the net sales. So it's going to look like the net sales minus sales return, then we get the net sales. Then we now come back to the other side and calculate the cost of goods sold, which is going to be opening stock plus purchase plus less return outward plus direct expenses. And direct expenses can be in the form of wages. It can be in the form of carriage inwards. So the first item there is sales. And the second item there is so we are picking this item. Then the second item there says return, which is 5,000, and return inwards, and return outwards. Then the opening stock, which is what? 33,000. That's 1,000 naira. Then the carriage inward, which is what? 4,000. These are the items that we will use to compute the trading accounts. So when you know the formula of net sales and formula of calculating cost of goods sold, then the items has already been classified into trading accounts. So we begin to post them. First, we limited income statement as at December 31st, 2025. In naira, in dollar, in metrics, or in centimeter. We are working in naira, so first of all, put it there. There must be a unit of accounts, so it is a naira. Thereafter that, we take the sales, and the sales here is 200,000. 200,000. Then you are going to less sales return, and sales return is 5,000. 200,000 minus 5,000 will give you 195,000, and that is in net sales. Then we go to the other side to prepare the cost of goods sold, and the item we need is the opening stock. The opening stock is 33,000 naira. The next item we need is the purchase, and purchase is 120,000 naira. Purchase now is 120,000 naira. Then purchases return or return outward, we minus it. Return outward, which is purchase, we minus it, which is what? 3,000. What we do next? We look for carriage inwards, which is the direct expenses. We add it. If there are other direct expenses like wages or other things, we add it there. Then we have cost of goods available for sale. The cost of food available for sale become 154,000. Then we will less closing stock from this figure to get the cost of goods sold. I mean, the closing stock is 40,000, and when we less it, we now get the cost of goods sold. And gross profit is net sales minus cost of goods sold. So it's going to be 195 minus 114, and what we have at this gross profit is 81,000. We balance it off. Take note that the trading account is not separated from the profit and loss account. We are doing this separation because of the length of our screen. We'll continue from here to prepare the profit and loss accounts. They are not separated, though they are segmented into two, but they are not separated. So let us go and prepare the profit and loss accounts. The profit and loss account deals with the indirect expenses. And the indirect expenses, as usual, are found in the trial balance. So we are going to pick out these indirect expenses. But the first thing you must do regarding expenditure is to go back to the information center of the question, where they talk about prepayments across regarding the expenses. This information must be adjusted because of the margin consent. In that information center or segment, we saw that there was a prepaid rent of 2,000 naira, and depreciation on furniture is 10,000 naira, and there is an outstanding salary of 3,000. All this value must first of all be adjusted in the expenditure they consign. Now, what are the expenditure that will come out in this section? The expenditure that will come out in this section are almost all the expenditure that is in the trial balance. The first one is what? Rents. Now, wait a little. Now, as you are about to compute the profit and loss accounts, and you take the gross profit to the credit side and expenditure to the left hand side, then there is something you need to do again. The revenue item. The revenue item must be incorporated into the gross profits. The revenue item like commission received, rent received, and other revenue items must be added to the gross profits. That is to say, you must add other income to the gross profits. Income like discount received, bank interest, reduction in provision, commission received, profit on sales of assets, and recovery of bad debts. If you have this information in the question, you add them to the gross profit. But since we don't have those information in this question, we just go ahead. And the first expenses we are going to pick there is the rent. The rent, according to the question, the rent in the question is rent. The expenditure I'm going to pick first is the rent. The rent there is 12,000. And do not forget, there was a prepaid rent. Prepaid rents are payments for an item which they have not enjoyed the service, so it's an asset, it's a current asset. Prepayment is a current asset, so we have to minus our prepayment from the rent. That is, prepayment is rent paid in advance. So the first one there is rent, which is 12,000, and is prepaid rent paid in advance, which is 2,000. So we are going to say 12 minus 2,000, which is 10,000. So the first expenditure is rent, 10,000. The prepaid expenses, which is 2,000, is removed. So we have rent is equals to 10,000. The next one is salary. Do not forget at the information section there's a salary. We treat depreciation first. Depreciation is 10% of furniture, and 10% of furniture is 0.1 times 40,000. 0.1, which is 10% times 40,000, and that will give you 4,000. 0.1 times 40,000 will give you 4,000. So depreciation on furniture is 4,000. Then salary, the salary there is 18,000, and there is salary outstanding. That means the company, the firm is owing some worker salary 3,000. That 3,000 is not included in this 18,000. So the salary for the period will be 18,000 plus 3,000. So it's going to be 21,000. So salary is 21,000. The next thing is electricity. Electricity, there's no adjustment there, and the value is 6,000. Then net profit is a difference between the summation of all the expenses and the gross profit, and this one will give you now 81,000. Immediately after getting the net profit, we've finished with the profit and loss segment of the final account. So the income statement gives us the gross profit from the trading account and the net profit from the profit and loss account. Now we are going to take a look on how to calculate the balance sheet. The balance sheet is a snapshot of the asset and liability of the business. So your classification on assets and liability For the statement of financial position, the first thing we'll take a look at is capital. Capital is a liability of the business to the preparator. Then drawing, we'll take a look at furniture, the motor van. We'll take a look at the creditor, or if any. We'll take a look at the debtor, the cash in hand, and the cash at bank. Those are asset and liability. There is rent prepaid. That is prepaid rents is a current liability, is to be taken cognizance of. There is also depreciation. Depreciation we will reduce from the cost of furniture. There is salary, that is outstanding, which is 3,000, is going to be part of the current liability. There is depreciation will also be taken care of in this section. Now, it is worthy of note. It is worthy to note that all the items in this trial balance are entered once in the balance sheet, but all the items in the adjustments are treated twice. Take note, any adjustment that is done must be treated twice. So we have debtor, we have creditors, and we have cash at bank, and we have cash in hand. These are current asset and current liability. So we are going to take a look at the statement of financial position, where we are going to group the asset one side and the liability one side. Do you know that the capital is a liability of the business to the preparator? So that is why it has to appear at the liability side of the account. And we are going to use the T format because of space. Now we have the liability side, which is the left hand side, and we have the asset side, which is the right hand side. So we are going to start with what the first liability there is capital. Capital, then you add net profits, less drawing. Take it again. Capital, add net profits, less drawing. We give you the adjustment to the capital. At times the adjustment is not done in this balance sheet, it is done outside. But because we do not have much information, so you can do it here. So capital is 150,000. Add net profits. If it is net loss, remove it. If it is net profit, add net profits. Net profits as calculated is 41,000. Net profit is 41,000. So we add it to the capital. What to do next? You less drawing. For the drawing, you less it. If the drawing was in form of stock, then you have to remove the drawing from the stock in the trading accounts. Drawing here is 10,000, so we have to remove 10,000 here. Now we have the value as 180,000. Then you add other liability like creditor, which is a current liability. There's no long-term liability, so we start by the current liability creditor. Then we have accrual what? Salary owing. Salary owing is 3,000, not 30,000. It's 3,000. In case you want to compute it, that salary, accrued salary should be changed to 3,000, not 30,000. Then in the asset side, you have the furniture, Do not forget the value of furniture is 40,000 less depreciation. Depreciation is 4,000, so it's going to be 40,000. This one that I'm writing minus 4,000, and now remain 36,000. So furniture, the value of furniture becomes 36,000, and that is the value that will go to the balance sheet. Then the net asset is what? Motor van. Motor van is 80,000. There was no depreciation of any kind, so we retain it as what? 80,000. Motor van is 80,000. Then we'll now start to talk about the current assets. The first current asset here is debtor. Debtor is 25,000 naira. Then we talk of closing stock. The closing stock is 40,000 naira. And look at the cash at bank and cash at hand. These are current assets. Cash at bank, which is 15,000. Then cash at hand, which is 5,000. Cash at hand is 5,000. Then we cast it using our calculator to sum them up. And if everything is correct, then they will balance. Okay, the prepaid rent there is there. If everything is correct, they will balance. But this one on the screen now will not be balanced until you adjust that across salary is 30, not 30, and it will balance. The balance sheet will always balance because it is taken from the accounting equation. Asset is equals to liability plus